Ah, tax season. It's that time of year again, isn't it? You're looking at your finances, and suddenly the big question pops up. Old tax regime or new? It really feels like you're staring at a puzzle, trying to figure out which path is actually going to save you money. Well, let's solve that puzzle together.
At its heart, this isn't just about numbers. It's about two totally different ways of thinking about tax. Do you want a system that gives you rewards for saving and investing, even if it means a bit more paperwork? Or are you looking for a super simple, no-fuss approach? By the end of this, you'll have a crystal clear idea of which one is right for you.
So let's start with the classic, the original, the old tax regime. I kind of like to call this the saver's regime because, well, it's literally designed to reward you for making smart money moves. And its secret weapon? Something called a tax deduction.
So what on earth is a tax deduction? Honestly, the best way to think about it is like a discount coupon for your tax bill. The government is basically saying, hey, if you put your money into these specific things, we'll let you chop that amount right off your income before we even start calculating your tax. So the more of these coupons you use, the smaller your tax bill gets. It's a pretty great system if you know how to use it.
And this is where it all clicks into place. See, the old regime isn't just a random set of rules. It has a purpose. It's trying to gently nudge all of us towards building a more secure financial future. It's the government's way of saying, look, we really want you to save for retirement, buy a home, and get health insurance, so we're going to give you a nice tax break as a thank you.
Now, if there is a heavyweight champion of tax deductions, it would absolutely be Section 80C. I mean, for most of us, this is the first and biggest tool we reach for when we're trying to save on taxes. So just how powerful is it?
Look at that number, 1.5 lakh rupees. That's a huge amount of money you can potentially slice right off your taxable income. To put that in perspective, if you're in the 30% tax bracket, fully using this one section saves you 45,000 rupees in tax, cold, hard cash. So what do you need to do to get this mega deduction?
Well, here's the good news. You're probably already doing some of these things. That money that automatically goes into your Employee Provident Fund, your EPF, yep, that counts. If you're investing in a PPF or an ELSS mutual fund, that counts too. Even things like your life insurance premiums or the principal part of your home loan repayment can help you fill up this sliver.
And believe me, the old regime doesn't just stop at ATC. It's a whole world of savings opportunities. You can get deductions for your health insurance, for the interest on an education loan, and even a massive deduction, up to 2 lakh rupees on your home loan interest. It really is a system built to reward you for all sorts of financial decisions.
Okay, so that's path one. Complex, but packed with rewards for savers. Now let's talk about the new kid on the block, the new tax regime. This one's philosophy is completely different. It's all about one thing: simplicity. But as you're about to see, that simplicity definitely comes with a trade-off. Here's the deal the new regime puts on the table. It says, forget all that complicated paperwork. Forget tracking dozens of investments. We're just going to give you lower, simpler tax rates. But in return, you have to say goodbye to almost all of those juicy deductions we just talked about. It's the ultimate trade-off: simplicity versus savings.
A simpler tax life with lower rates? Sounds pretty good, doesn't it? But before you jump on that bandwagon, you have to ask the most important question of all. What exactly are you losing in exchange for that simplicity?
All right, it's time for the main event. Let's put these two regimes head-to-head in a direct showdown. This is where the rubber meets the road, and you'll see exactly what you gain and what you lose.
Let's just quickly recap the core idea here. On one side, you've got the old regime, which is all about rewarding specific financial choices. It's a system of incentives. On the other side, the new regime is all about simplicity, a straightforward you earn, you pay system with basically no bells and whistles.
And this table right here, it tells the whole story. Under the new regime, that huge ADC deduction, gone. The break you get for your health insurance, gone. Your HRA exemption and that massive deduction on your home loan interest, all gone. It's almost a clean sweep. The only thing that really carries over is the standard deduction, which is a little bit higher in the new system. But you have to ask yourself, is that little extra bit enough to make up for everything else you just lost?
If that table didn't make it clear, this chart sure does. Just look at the difference. The number of tax-saving tools you have at your disposal literally plummets when you switch to the new regime. It's a massive shift from a system with tons of options to one with, well, almost none.
Okay, but there is one really important exception you should know about. If your company contributes to your National Pension System or NPS account, that deduction is still allowed in the new regime. This is a super important detail, especially if your job offers a corporate NPS plan.
So, we've looked at both paths, we've compared them side by side. Now, for the most important part, let's bring it back to you. How do you take all this info and actually make a smart decision for your own wallet?
Well, the answer isn't in some complicated tax law book. It's in your own life. It's in your bank statements and your pay slips. Just take a second and think. Do you have a home loan? Are you already putting money into things that qualify for ADC? Do you pay for health insurance or rent? The right choice depends completely on what you're already doing with your money.
And really, it all boils down to this. Add up all the deductions you can claim under the old regime. If that number is big, chances are the tax savings from the old regime will be way better than the lower rates in the new one. But if you look at your finances and realize you have very few deductions, then the simplicity and lower rates of the new regime might just be the perfect fit.
And that's the absolute bottom line here. There is no single best tax regime. Anyone who tells you one is definitively better than the other isn't looking at the whole picture. The only thing that matters is which one is better for you and for your specific financial life.
So, here's the final question I'll leave you with. It's time to actually run the numbers. Are all your savings and expenses, your potential deductions, valuable enough to outweigh the pure simplicity of the new regime? Only you can answer that. So, grab a calculator, take a look at your finances, and find the path that's right for you.